Hi there, and welcome to the first video for Chapter 1 in your Cornerstone's textbook. This is going to just be a basic introduction to the terms and the concepts that you will be experiencing throughout this course on accounting. So first of all, let's try to figure out what accounting is. Have you ever heard accountants called bean counters? Well, the history of this profession goes way back to a time when people who were accountants simply did just count things, whether that was items in inventory in a business or inventory in the military. They just counted things, but the field has definitely evolved. Now we say that the definition of accounting is the identifying, measuring, recording, and communicating of financial information. Financial information means anything that deals with the finances, the money, the profits of a company. Why do we do this? We do this so that managers can make informed decisions. This is not merely so we have nice, clean records, but we use those records, both historical and thoughts about the future, to help make good decisions. Now, your textbook on pages 5 and 6 go through three major forms of business organization. The first two, sole proprietorship and partnership, are very similar. The only difference is in the number of owners. Both are simple and pretty easy to set up. They are both entities that are separate from the owners. And in both cases, all owners are liable for all of the debt or any negligence that the company may incur. A sole proprietorship has exactly one owner. A partnership has two or more. Now, in the United States and other nations, there are things called corporations. Corporations are more complex, and in the United States, each state or territory has separate laws about how a corporation is set up. Corporations are owned by their stockholders, and there are generally 100 or more. But each stockholder, though they are liable for some of the debt and negligence of the company, they are only liable up to the proportion of their ownership. So let's say a stockholder owns 1% of the stock of a company. That stockholder is only liable for 1% of the debt or negligence of that company. Though there are major pros to forming a corporation in terms of the limited liability that stockholders have, corporations do generally, at least in the United States, experience higher taxes. Now, what do businesses do? Well, they engage in business activities. And on page 6 and 7 in your textbook, you notice that there are three main business activities. They fall into three categories. There's the financing activity. And in financing, the business is trying to obtain funds to begin and operate the business. They either get these funds through debt, which means they now have an obligation or a liability owed to their creditors, or they get the funds through something called equity, which will create more stockholders who have a claim on the assets of the company, but it is not an obligation. Equity creates more owners. Going into debt creates creditor relationships. The second business activity is investing. This is the buying or selling of assets to enable your business to operate. This is where you buy buildings or buy equipment or sell some equipment. That is what we're talking about when we're talking about investing. Do not confuse financing and investing. As a business, financing is about getting the money to fund your operations, and investing is the buying and selling of the assets that you use in your operations. Thus, the third business activity is the operating activity, and this is the regular day-to-day operations of the business. If you're McDonald's, this is the making of hamburgers and French fries and the selling of them and the cleaning up of the restaurant. In the course of operating, a business will incur costs, which we call expenses, and they attempt to earn a profit as they make sales, which we call revenue. Let's practice and make sure that we know how to do this. On page 37 in your textbook, exercise 124 talks about Bill and Steve's awesome high-end appliance company. They manufacture high-end kitchen appliances. Let's look at the following activities and make sure that we know what kind of activities they are. First off, both Bill and Steve each contributed cash in exchange for common stock in the company. What kind of activity is this? If you said financing, you're correct. This was an activity whereby Bill and Steve's company got funding for its operations. In the second event, land in a building to be used as a factory to make the appliances were purchased for cash. So they bought some assets. What kind of activity is this? If you said investing, you're correct. Machines used to make the appliances were purchased for cash. What kind of activity is this? If you said investing, you're correct again. They bought assets that they will use in operations. Various materials used in the production of the appliances were purchased for cash. Well, this one's kind of tricky. We would normally say that this is operating because those materials will be used up in the course of creating the high-end kitchen appliances. If you said investing, you were thinking along the right lines, but in accounting, we separate the kinds of assets that stick around for a year or more, things like machines and land and building, and then we have other assets that get used up in the course of manufacturing. And in this case, we were talking about the latter, so that would be operating. 3 employees at Bill and Steve's business were paid cash to operate the machines and make the appliances. What kind of activity was this? It was operating. Running low on money, the company borrowed money from a local bank. What kind of activity is this? Yes, it's financing. The money from the bank loan was used to buy advertising on local radio and TV stations. If you thought investing, you were sort of thinking along the right lines, but think about advertising. Is it used up? It is. It's not an asset that sticks around. It's an expense, in which case this is operating. The company sold the appliances to local homeowners for cash. They sold the appliances they made, and they made some cash. What kind of activity is this? Exactly. They made sales. They made revenue. That's operating. Due to the appliance's popularity, they built another factory building on its land for cash. What kind of activity was this? Yes, it was investing. They made another long-term asset. Lastly, the company paid a cash dividend to Bill and Steve. What kind of activity is this? When you pay your stockholders a dividend, if you say financing, you're correct. Though the company did not receive new money, they did not receive new funds in this process, they did decide to continue their relationship with their stockholders and they paid them a dividend, and that would be financing. All right, some basic terms that we're going to be encountering as we go through our study. You're going to have major categories of events and accounts that occur in accounting. We are going to have assets, liabilities, and stockholders' equity that all are found on the balance sheet. Assets are the economic resources of a company. We use them to create our product or service. Liabilities are debt. Remember, in some way they are obligation to repay a creditor. Stockholders' equity is the claims that the stockholders or the owners have on the assets of the company. Then, in the course of operations, the company sells things to make revenue, and we say that's an increase in assets that results in the sale of products. We made something, we had an asset, we sold it, and we now have revenue. We have expenses, which are the cost of the assets used, or potentially even liabilities that were created in the operation of the business. And then if I take revenue minus expenses, I either get net income or net loss. Now, we don't like net loss nearly as much because net loss means that the expenses were greater than the revenues. So I have a negative profit. If I have net income, that means my revenues were greater than expenses, so I have a profit. All of these are found on the income statement. So, what are those financial statements? We've got the balance sheet, which of the 4 major statements that we will cover is the only one that is a snapshot in a particular period in time, one moment in time. It will tell us about the assets owned by the company, as well as any claims against those assets, either liabilities or stockholders' equity. The income statement is a report that covers a period of time, maybe a month, maybe a quarter. A calendar quarter is 3 months, or a year. It will show us the revenues that came from sales in the company and all the expenses from the use of the assets and the resulting net income or net loss. The retained earnings statement is also over a period of time, and it shows how much income was retained. Remember this income up here from our income statement? That idea of the profit that was left over, how much of that was retained and how much was distributed to the owners. Now, how do we distribute money from the company to the owners? That's right, it's dividends. Lastly, we have the statement of cash flows. This is another report that covers a period of time, and what it does is show us the sources and uses of cash so that we can understand the net cash used. Now, these statements are generally prepared monthly, quarterly, or yearly, and they are prepared according to what we call GAAP. And this is not the GAAP, where you get clothing. It is GAAP, meaning Generally Accepted Accounting Principles. And these are the rules and the principles that govern how accounting works in the United States. Now, we need to cover one very, very fundamental equation. Assets equal liabilities plus stockholders' equity. Now I want to go back. If you recall, we said there were assets, liabilities, and stockholders' equity, and all of them are on the balance sheet. Well, it turns out the balance sheet is called the balance sheet because it must balance. And that balance occurs via this equation. Assets, the total of all assets in a company must equal the total of all liabilities and the total of all stockholders' equity. The left side of the accounting equation shows the assets. The right side shows the claims on assets. So we've got assets and claims on assets. Those claims on assets are in two forms, if you recall. There's the creditor claims. These are obligations that are owed. Liabilities are things we owe as a company. And then we have the owner claims. Stockholders' equity shows us what is owned by the stockholders. This fundamental accounting equation will appear again and again and again. It's important that you understand that assets must equal liabilities plus stockholders' equity. And again, all of this is found on the balance sheet. Let's just test our understanding of that equation. On January 1st, 2011, Gundrum Company reported assets of $125,000 and liabilities of $75,000. That's at the beginning of the year. During 2011, assets increased by $44,000 and stockholders' equity increased by $15,000. So that's what happened over the 12-month period. Let's start at the beginning of the year. What is the amount reported for stockholders' equity on January 1, 2011? How do we do that? Well, if assets equals liabilities plus stockholders' equity, I'm just going to abbreviate there, and we know that assets was $125,000 and liabilities was $75,000, can't we plug that in and find it out? Well, just wait a second. Let's understand what else we're going to need to do in this problem. We also need to know what would the amount reported for liabilities at the end of the year be? Can't we use that same accounting equation to do it? Take a minute, press pause, and see if you can answer both of those questions. Okay, let's focus on the first one. We know at the beginning of the year that assets equals liabilities plus stockholders' equity, and assets were $125,000 and liabilities were $75,000. If we plug those into the equation, we find that stockholders' equity was $50,000 because obviously we subtracted the $75,000 from both sides. Now let's go to the end of the year. the end of the year, we know that assets had increased by $44,000, $125,000 plus the $44,000, and stockholders' equity had increased by $15,000. We knew from our last answer that it started with 50. We add 15, so we know total assets to end the year were $169,000, and total stockholders' equity was $65,000. So we know that assets plus the stockholders' equity plus the liabilities have to be equal. If I subtract $65,000 from both sides, I find that the total liabilities at the end of the year were $104,000. This concludes our first video for Chapter 1.